Great. Okay, so welcome everybody to tonight's session of the new note. It's very exciting. It's been a while since we've had a note because there's just been so much going on in the world, and Andrew's going to be sharing that with us. Just a reminder that we do not provide advice. Cashbox Global is a financial services organization registered and regulated in Mauritius and South Africa. We design and provide global investors with education and information about defined investment products called structured notes.
Thanks very much. Hi everybody. I was away today. The beautiful area of the Garden Route in George. And finance takes you into different places. This morning I was trudging around a forest, part of a plantation that a client is busy selling in terms of rationalizing his assets. So it's quite interesting. It takes you into interesting places with interesting people. I think that's a very interesting building we're looking at. I think we all know what it looks like from TV coverage and from social media, etc. It is a beautiful building. I love history, and I actually did some research on who built it and when it was built, and some of the fabulous facets of the rose garden and this room and that room. This is a sort of a note that we've tried to put ourselves in the shoes of an American corporate in terms of how are we going to react and behave in terms of the new social order or the new business order that's taken place. I did actually get home slightly earlier, but I was drawn away to another screen as I was getting dressed into my Zoom outfit, which kind of just encapsulates a little bit of the noise. We did a webinar recently about the noise that we surrounded with in terms of social media, news feeds, the press, social commentators, economic commentators, business, asset managers, private banks, you name it. There's so much that assaults us. But one of the things that I picked up as I was running past the TV was CNN was on it, and I came back to my Reuters screen, is that in terms of this ongoing tariff thing, and that's what it's all about tonight. We're going to be dealing about that in terms of how do we position ourselves in this tariff world, is that the Chinese and the Americans have just come to another 90-day extension. Can you believe it? This afternoon. Well, it's morning in the US, morning, Pat. But it is definitely another, sort of ratification and validation that this is a big negotiating sort of set of talks around the world. It's a reset. But it literally means that for another 90 days, there is this uncertainty. Markets will react one way or another. The narratives will come out, and this noise, as I spoke about, will continue. Interestingly enough, one of the really interesting things, and we've got this, and I know there are new people on the call, and there's some seasoned investors on the call. I'm not going to call you out, but I'm so glad you're here because we've got some stocks that are in various notes that are really behaving very interestingly in this tariff behavior, especially this US-China paradigm. There's the Uber order, yeah. as Joel mentioned. But there's some really interesting nuances going in. So, for example, NVIDIA, as we all know, they're one of the most valuable companies in the world, has just agreed with Advanced Micro Devices, it's probably its biggest competitor in the semiconductor chip space, to pay away 15% of its profits that is made in China to the US government for the purpose of continuing trade. And in one of my bullet points, and I thought I'd mention this because in one of my bullet points, you will see, and this is an energy note, not semiconductors, is that corporate America is starting to use its muscle to leverage some sort of arrangements as well, besides the government coming down with this top-heavy, let's kill an ant with a hammer kind of approach, which has been we were assaulted by this from the 1st of April of this year with this whole tariff thing. So that's where it started from. We sat down as a team, and we said, where do we go in terms of positioning a note that might have some, so it might be a little bit anemic in terms of being affected by tariffs. And that's what we've all been talking about. Where it doesn't matter where you are in the world, tariffs has been the driving narrative around investments and how do we position one's portfolios and your outcomes. And we haven't departed from our thematic approach. We're very theme orientated, as many of you will know. But we looked at it from a point of view of what makes sense now, and will it make sense in 3 years' time if it's a 4-year contract? And Graham and I have spent many hours, we spend a lot of time together, um, bashing it like a ping pong ball backwards and forwards to try and get the optimal shape, but that fits in with the Cashbox narrative of we are trying to find something that is resonant for the moment, and it makes sense now, and it'll make sense later, without being too negative and too over optimistic. And given this tariff tide, if one calls it, that's lifting all the boats and causing people to look under the boats to see what sharks are swimming there, we decided to look at something that was specifically intra-American. In other words, what makes a country go around? And at the end of the day, it's energy. Okay. And energy comes in many, many different sources. So let's have a look. We'll get into it now. So that's my sort of preamble. It's issued out of BBVA, which is a Spanish multinational investment bank. It has a tier 1A rating. I think 16th or 17th largest investment bank in the world. Joel, the chat is going to take you through the actual verbiage there in terms of reducing auto calls. Many of you will understand it, but it's a growth note. In other words, this has to mature early. We have to have a trigger to make the coupons, which is 17% per annum, okay, so it's 8.5% semi-annually, kick out. The first observation is at 12 months, and the last observation is 4 years later, okay? But we need those underlying stocks to actually be in the right position to auto call or to early mature for us to realize that. So it's a growth note. It doesn't pay away. It accumulates like a big snowball going down the hill. You'll see they're closing Monday, the 25th of August. And I think to steal a little bit of Graham's thunder, for those of you who were on the call when he was speaking, we were speaking a little bit earlier, and I didn't reply to him, so he's obviously got some answers. But we've had a lot of I won't say pre-sales, but a lot of enthusiasm and a lot of take-up of the inventory that we've got. BBVA, we've got a great relationship. We do a lot of notes with them. And they've come to the party in the past and they've said, look, we'll stretch it on the same T's and C's. We'll give you what you want, but we can't just keep stretching it. If you have a $1 million inventory or $1.5 million inventory, we might be able to stretch it to 2 or 2.5, but then you have to start a new note. Tariffs came in, when Donald Trump sort of came into power early January after the elections. A lot of his pre-election promises were brought to bear in terms of what he was going to do. And I'm going to really just focus on the trade side of things in terms of a historical reset within the business world in terms of how they dealt with parties, both friend and foe alike, globally in terms of their business flows. And we were hit with this reciprocal tariffs in terms of what we would have to pay or what was going to be taken off the bottom line in terms of if you were importing into or exporting into the United States as a business partner. And a lot has been said and a lot has been written about the whole tariff situation. Is it good? Is it bad? Will it manifest itself in the next 6 months, in the next year, in the next 10 years? How will it affect interest rates in the United States? What is this Make America Great Again all about? And will it actually do that? How will it affect, corporate America? How will it affect the man in the street? So to come back to my initial sort of when I kicked off saying we try to put ourselves in the shoes of an American, maybe businessman, maybe investor, maybe the man in the street, Joe and Mary. How are they seeing it? And we take it from quite an objective view because we actually don't know. We have, as I mentioned, we do have some American investors or people living in America now who have got investments. But it's an evolving situation. And with respect to, and I've looked at the names here on the guest list tonight, there's some very articulate people from family offices, hello Dan, and very erudite people. I would suggest that it's going to be an evolving situation that nobody can really guess because of the mercurial nature of the man in the video. Whether it's a flip-flop policy, whether he changes his mind, whether we get these deals with, as I say, with American extensions with China now, wars, ending wars suddenly all over the world, et cetera, et cetera. It's very mercurial. It's like a pinball approach. We're not quite sure, and it's difficult for for investment, the investment community, and let's rather address it in that point, to make plans in terms of where should I be. So we looked at from the point of view of, and the next slide says it all. Where do you go? And it doesn't matter where you are in the world. And many countries aren't on that. That's just a sample sort of slide. Where do this was when it was first pumped up in April, and we all know what happened. Markets went into a tailspin, and we can address that shortly. But for example, I actually went through these two lists here, and one of the prime candidates that was smashed, but doesn't really appear here, and really what's happened to it now is it's been downgraded to a mediocre 15% is Venezuela. Many people don't know that Venezuela is probably the country sitting on the biggest or the biggest untapped reserves, I beg your pardon, of oil in the world. And that's why there's an intense interest in the States in Venezuelan politics. So the weaponization of economic policies into politics is a bit blurred, but it does happen. Just so happens that China is the biggest buyer of Venezuelan oil. Makes you think. So there's the connection, there's the segue. But this was something that sort of gave us context in terms of how do we set the parameters of creating a note that is currently, that we can make resonant to the current features that are affecting our lives, okay, as investors. Where can we weather proof as much as possible the earnings of a business? Now, you all know, if you read my weekly reports, I'm very focused on what's a company's earnings, are they quality earnings, where are the earnings coming from, et cetera, et cetera. And I looked at this in terms of saying, okay, well, what's going to keep the lights on in America? So let's move ahead and just have a brief history, okay? Because I know my time is limited. This is a short history of tariffs. On the 1st to the 7th of August, tariffs started way back in April, and we all know what happened. If you look at any of the graphs, we can pump up a few later, markets went into a tailspin. But on the 1st of August, it was a very black day. Okay, the 2nd and 3rd, it all recovered. That's the noise. It went down. It just so happened that OPEC, which is the oil-producing, exporting countries of the world, decided to increase production. At the same time, the U.S. jobless report came out. It was very lackluster. So it kind of said like, oh, maybe America's going into, the unemployment situation is going to lead to a recession, is going to lead to this, that, next thing, given that the Federal Reserve is hanging on to its, its interest rate. And on the back of that, all sorts of things happened. The U.S. Treasury yields fell, global equities tumbled, not just in the States, but globally, because people were saying, oh, inflation is back. We're going to get an interest rate cut, but that's not really going to help. It's too late. And that was on the 1st. And on the 7th, the actual tariff implementation actually started. And it was a little bit of a non-event in many respects, because many countries had said, well, we're going to renegotiate further, like Mexico at the stage, to protect their tomatoes. And if anybody's read my weekly wrap on tomatoes, you might get the hint there. I suggest read them. They're really good. They sort of link each week together in a way. But it's marked as I said, a structural shift. It's not a once-off. This is going to be an ongoing situation in terms of negotiation, in terms of transactions. The Republican Party under President Trump he's a transactional president. He wants to get the deal done. Read The Art of the Deal, okay? But it creates protectionism of the American economy. Make America Great was the key tenet that he stood on to say, that's what we got to do. If we have to cut global ties and deglobalize, we will go back to this protectionist, isolationist kind of situation, whether it be through NATO, whether it be through trade, whatever. We're going to go back and fix ourselves. He mobilized the National Guard this afternoon in New York City to take out crime and drug dealers. He did it in LA, etc. So he's doing some stuff that resonates with a lot of Americans saying, let's get things right, let's make things work. But in a business sense, it's become evident that it's a negotiation tool, these tariffs. And investment sentiment, if you go to the 4th bullet or the 2nd bullet point, it's souring, because people are sort of said, we understand what's happening now. He's going to have another extension. He's the taco king. Trump chicken's out again. That's what it stands for. And he'll have another extension. And people start factoring that into their thinking, which can be dangerous because he's mercurial. He can change his mind at any time. And certainly, if you're a businessman, How do you plan for that uncertainty? But certainly in terms of certain areas that we've now looked at from this inward focus on America, how do we create a note that's going to be tariff exempt? Autos is out. That's very heavily affected. Steel, aluminium, those big imports are tech. Okay, be it what I said earlier about NVIDIA and AMD paying 15% of their profits away. That's very interesting. So corporate America is also starting, as I mentioned, using its muscle, starting to do some leverage. But it's not just America. Globally, we felt the pain. Markets were wobbling. People weren't sure about, where do we go from here? What's going to be the next move? So they've had the synchronized risk off. Like, let's rather go back into cash, maybe into bonds, maybe into more defensive strategies, and let's watch and see. And I always say this creates a level of volatility. But if you look at the markets at the moment, volatility is actually low. People have, I think, have factored that in and accepting it as part of the premium they pay with this particular administration. So, we put ourselves in the issue point. So let's in the issue points, in the issues. So if you want to go to the next slide, it's a quick read. It's very simple. Given my pretty negative view, okay, where is it going to be within the US that's going to be protected? Okay. Local production, if you've got a business there, if you've got, you create your revenues and your earnings out of America. So it's not because somebody's sending you something that you've then got to add to a product to then sell. It's simply made in America for Americans. Okay. Never mind the hedging strategies. That's a technical sort of situation in terms of how do we protect our agriculture, because that's a very, very big sort of situation. But look at the second word, energy. How do we protect energy? And it's very simple. Donald's come out, and you'll see it. Drill, baby, drill. That was his mantra during the elections. He said, I am full behind hydrocarbons. Renewables, you've got your place. You can stay there, and I'll deal with you later, which he's now dealt with by taking all the tax credits away and creating he's created a less benign environment for them to produce. So he's going back to the oil majors. He's going back to traditional focus in terms of where America got its energy from. And it goes back to, when they found oil, and there's a great picture of when they had their first gusher. So again, this is not a temporary jolt. This is going to be an ongoing thing. And I think tonight's validation, where China's now got another 90 days, as is Mexico, as probably will the EU have something else. It's going to be ongoing, and we have to adjust the narrative accordingly. But energy is, you got to keep the lights on. So this is the current focus. This is what we looked at as a team, and we said, like, okay, well, where's the generation of energy coming from? Okay, if you're going to bring all this manufacturing back to the United States, okay, because that's what he's basically saying. Everybody's got to produce the stuff in America. That takes time. You need electricity. That's a core ingredient. Where it's coming from is, it's pretty obvious. It's the legacy energy suppliers, the big oil majors, as we call them, these mega monolithic companies that have diversified into renewables, into all sorts of things. But their main focus is the production of hydrocarbon energy, which is essentially oil. And oil is a volatile subject, and we'll talk about that. Renewables, as you see, it's part of the deal. And we've been in renewables before. Renewables don't feature in this particular note. Nuclear, very definitely. He's done 4 executive orders, those things with a big pen and the big signature that everybody gets excited about, and he throws the pen. Very important. He's renegotiating the entire nuclear situation. It's very important. Okay. So let's carry on. What's changed? So the policy shift, if you go to the next slide, the policy shift is clearly back to oil and nuclear. Drill, baby, drill is, I don't think when he was on the dance floor with Jeffrey Epstein somewhere in some nightclub, it was about oil, okay, his energy focus. The repeal to the tax cuts I've mentioned, the reform of nuclear. And the US last year used 30% of the global production of nuclear energy. So clearly there's a focus. Clearly what happened with 9 Mile Island in 1979 has gone. I mean, the particular company that we've included in this note, Constellation Energy, is actually redeveloping that because it needs to provide energy for a certain company called Microsoft that it's signed a 20-year agreement with. It signed a 20-year agreement with Meta. These are all the AI drivers that are driving. They need energy to drive all these particular requirements of theirs. So these are just examples. But I think one of the biggest things that the Americans are doing is they're building an energy moat. Now, I'm a big advocate of building a moat around your investments, of saying we need to protect what's inside the castle walls. And an energy moat is something that they've learned that the Europeans had become very unfocused and lackadaisical about, because when the Russian invasion of Ukraine happened in 22, the EU and NATO said, right, sanctions, this. And the Russians said, that's cool, we'll just turn off the gas. We'll turn off the energy. And the world is so interconnected, especially in that part of the world. There was massive, massive problems, structural and systemic problems in the European energy system. It was literally a case, and my daughter lives in the UK, in London. It was a case of eat or heat, because you couldn't afford the heating and the eating, the food and the energy. It was very, very expensive. And it's a leverage point. It's a politicized leverage point. And that's what I think is happening now a little bit in terms of the wider, he's gone global, and the Republicans have gone global a little bit in terms of their strategy. So they've learned a lot of lessons, and they're building a moat to make sure that if you're in America, and if you're an American company, and you're less constrained with the tariffs that are going to be imposed on you, your earnings are going to be pretty safe. But there's a lot of volatility, and there's a lot of stuff that can infect the energy system. So I'll give you an example of this. Okay, so these are the companies that we've chosen, and I'll deal with the one that's been sort of knocked out now. So I've mentioned BBVA has underwritten this as the guarantor with a 17% coupon, observed semi-annually, so it accumulates until all companies at the right threshold, and then it'll end subject to them being there. Enterprise Partners Product Partners L.P, limited partnership, is the third one down, and the other ones you may have heard of: ExxonMobil. Okay, it's the second largest oil company in the world, ahead of Chevron, which is the third largest in the world. Just to give you an idea of size, the largest company in the world is Saudi Aramco. It's based in Saudi Arabia, and that's based as a market capitalization of around about 1.5 trillion dollars. So massive difference in terms of Exxon being at sort of 500, call it 457, and Chevron being around about 300. So these are massive companies, 300, 500 billion companies. Very, very large, been going a very long time, gobbling up all the competition. As I mentioned, ExxonMobil is number 2 in the world, Chevron number 3. So we've got 2 and 3 out of the top 5 in the world, or the top 10 in the world. Mobil, I think, is down in somewhere like 8th or 9th position, just to give you an idea in terms of another household name. So very, very large companies. But we look at the companies themselves in terms of how valid are they, in terms of these are American companies. They are based in America. Yes, they are global, and yes, they're diversified in that pie chart into all sorts of other things, but they are subject to the tariff legislation and the regulations, which is important. Okay, so if I look at, for example, Chevron, okay, number 3 in the group, it's got just under a 4.5% annual dividend yield. Okay, besides its growth, 4.5% dividend yield. It's paid for 32 years without missing. So very regular, very solid, very staid on it chugs. It's like those super tankers, which it puts its products in, off it goes. It's A-rated by the agency, so it's one of the top. It's a top credit-rated company. The same for ExxonMobil. It's an amalgamation of various companies. ExxonMobil's probably had its worst possible reputational sort of drama visited when the Exxon Valdez just pretty much ran aground in the States, and there was a massive spill. Oil is a dirty product, and it kills, if it's raw in its raw state and in its sort of gaseous state, it's not a great thing. Hence the move to renewables. Again, it's an A-rated company by the Fitches, the S&Ps, and the Moody's of this world. That's got a 3.7% dividend yield. So these companies regularly pay I'm talking about decades, not quarterly. These are decades long. Very solid. I'll deal with Enterprise because it comes up in the presentation. They're not a drilling company. They're what's called a midstream company. So those are the guys who run pipes all over America. They have pumping stations, they have pipelines, they get royalties paid by the land that the pipelines go over. Very competent business, cash flush, lots of money, good balance sheets, been going for a long, long time. Certainly this particular company has. And they provide the conduit from the drillers, okay, from the guys like Chevron and Exxon who out there, they're called upstream, giving this sort of a 101 of oil. They're the upstream guys drilling, exploring, finding it, and then they pump it back, and these guys provide the pipeline. So they're pretty important in terms of the mechanism of getting it to the refinery. And that's what's called downstream, okay? Downstream is where you refine it, you market it, and you sell it to your consumers and around the world, etc. So Enterprise Partners, that's what they do. Again, they're probably one of the highest dividend-paying companies, certainly in the States. And that particular sector pays a very high dividend. Let's have a look at Constellation. Constellation is a US-based nuclear company, one of the best. It's found across all the electronically traded funds, mutual funds, all the big fund managers put it into their nuclear and uranium ETFs or unit trusts, etc. It's pretty much a shoe-in because it's there. Now, nuclear has got, as I mentioned, it's all in the rationale, which is a document that should be read aside to this. Nuclear has become very, very popular with Trump. As I said, he's written 4 executive orders about nuclear and how he wants to push nuclear. Nuclear is not an easy thing to push down the road, believe you me. It's not, getting your product from A to B is one thing. For the enterprise, which is now out. Drilling it is one thing. But creating a nuclear power station takes a lot of time, takes a lot of regulation, and takes a lot of money to build a new nuclear power station. They're sitting in a position now where they've got the infrastructure, they've got the existing assets to create this. And it provides a very safe, if I may say so, and consistent supply of power to the American grid. You saw what it said in the pie chart, 26% odd. So it's recognized as a very, very important component. Roughly at the moment, it's about just under an A in terms of credit rating. So if I have to be absolutely fair, the oil majors are in the A. This is just bubbling under the A. But in fact, as Moody said, they said it's just under A because it's reflective of its improved management, its strong financial performance, and very, very much so the supportive policies that have been plowed into nuclear. Nuclear last year had phenomenal pricing. Okay, so this company did pretty well. It had very good returns, but the market now is chasing the nuclear space. So the pricing has gone up. That was one of the first pictures of the guys producing what's known as a gusher, where they actually hit the black stuff, the black oil, the black gold. I think as that center pivot went higher, they all went under and had a quick shower in some oil. But that's where it all started. I think that was from 1896 or so. And if you look at the next particular slide, you'll see how it's gone into a full-time business globally. Whichever continent we are looking for oil. I did an interesting study. I said, will the world ever run out of oil? Because by then we hopefully have worked out what we're going to replace it with. And as I mentioned, some of the largest untapped reserves are sitting in Venezuela, and they're talking about 30, 40 years of production. And again, it works down to supply and demand. You don't want to oversupply and outstrip demand, and also you don't want to have too little production, and you've got a world that's screaming for oil. So there's and there's obviously political issues involved here in terms of who wants to bring pressure to bear on whatever it might be. So that was the land-based stuff. So Exxon, Chevron, they're in the space. They're in the next slide as well, which is offshore. This is whether your oil is hiding at 3 kilometers or 6 kilometers under the water, these guys will find it and they'll drill it out and they'll pump it out, dependent on requirement. Output is very much an economic supply and demand. Too much supply and you drop the price, and obviously then these companies' earnings get affected. And little, if there's too little, also it can be affected. So oil is volatile. The next one really was a slide that I put together in terms of, thank you, Jill, she put it together, was kind of a segue from we're pumping it out and now we're delivering it, because the partnership guys obviously we're in the queue to deliver this. It looks like a very rusty old tanker, but to deliver it around the world globally. Now, against the world of tariffs, clearly many of these, I mentioned the Exxon Valdez, many of these major oil companies have their own fleets of ships, and they need to build those. And what do you need for that? Steel. So they better be buying, American steel, because if it's imported steel from India or wherever it might come in, it's going to be more expensive to produce. And many of you may not know, but there's a U.S. company called U.S. Steel. It's over 100 years old. It's been running forever. And it was going to be acquired. It's almost like a national treasure, U.S. Steel, like the old cowboys. And it was going to be acquired by a company called Nippon Steel, a Japanese company. And part of Trump's pledge during his election was that there's no Japanese company going to own one of our icons. And it came to bear that there was a lot of negotiation around that. And it wasn't a done deal. It was kind of stopped in its tracks. So again, politicization. There's a circling of the wagons here in terms of American energy, of protecting American interests at home and American companies at home. So is that a valid enough reason to create a note that's going to have these embedded companies, these massive American companies, now in the nuclear space and in the oil major space, providing that? So let's have a look at what affects them. That's the refinery side. That would be again part of the downstream that affects the Exxons and the Chevrons. The next one is there's the move into the next slide is the move into nuclear. Very, very powerful. This is a very, very powerful movement in terms of what he wants to do. As I mentioned, the American nuclear energy sector has gone into stagnation for probably the last 20 years. It amounts to probably 20% of today's America's electricity. But it was probably around 19% 20 years ago. So it hasn't grown exponentially. Okay. So why is the price of these companies that's just taken off? And I think generally, you've got to look at the fact that given that the nuclear share market share remained fairly steady, I think one key reason for the lack of growth was probably the limited demand for electricity. But now what we're seeing is not just the AI guys saying we need more electricity, but Trump is saying manufacturing has to come back to America. That's the whole tariff thing. That's the whole overarching issue of tariffs. You need to bring manufacturing back because it'll create more jobs, more revenue, more taxes, more money in the hands of the American wallet. And that's going to create something different. During World War II, during the height of when America really needed to throw its weight behind the UK, when it was on its knees facing Hitler, there was it was run actually by the Ford Motor Company, but they turned the Ford Motor Company into an aircraft company. They made Baltimore bombers. And it worked 24 hours a day to create bombers. Okay, they worked on 3 8-hour shifts. Now you can imagine the power that went into that. If America has to gear up and tool up, and many of these companies are talking about this, then they're going to have to make a massive infrastructural spend into America, and everything runs on electricity. If any of you read this weekly wrap from Saturday, Sunday, when Jill sent it out, Apple came to a $600 billion deal, $600 million deal. A billion, sorry, I beg your pardon, where over 4 years, they'll be investing in America simply to get the tick in the box from the government. They're going to move their manufacturing. It was in China, then it was in India. They bring a lot of it back to the States. That's going to take a little bit of time. It's going to take a lot of energy. That comes through electricity, it comes through power generation, etc. So I think the consumption is going up. We saw what happened with COVID, with oil supplies. That's a nice picture of a sort of a nuclear facility. This is a big, big sector that's going to benefit going into the future. It's had a past where whether it was Chernobyl, whether it was 3 Mile Island, etc. There have been some huge issues in terms of safety and regulation. Hence his repeal in terms of the NRC, the Nuclear Regulatory Commission is going to be revamped. So let's have a look at, if I'm talking volatility of let's say oil, how does it compare against the S&P 500 if you'd bought a portfolio of stocks, or the NASDAQ 100 with all the darlings in there? Okay. So let's really, this is over a 3-year period I did this, okay? You got the categories there. Let's take out midstream energy at the bottom because that's Enterprise Partners. You're looking at S&P, NASDAQ, and energy. There's the dividend yield. People would buy the energy and midstream for dividend. Price earnings ratio is literally, how long is it going to take to get your initial investment back over a number of years from the earnings that the company distributes? And you can see the energy sector is well below what the NASDAQ and the S&P basically come in and over that 3-year period. There's your 3 years annualized growth. Okay, it's not great. Energy doesn't grow a lot. But in a structured note, as you all know, and if you read the rationale, we don't need to grow because we've got features in there that bring the actual requirement for growth right the way down, which is the unique feature of a structured note, as opposed to holding the stock, Exxon or Chevron. But have a look at the peak. That's what I quite find interesting. That's volatility. That's like you wake up and you think, my portfolio has been absolutely murdered overnight because something or other has influenced that particular share, that sector, that economy, that demographic, or that geography of the world. Energy has been pretty basic, 18% from its peak. Okay, so let's have a look at volatility of oil, because this is like really in point now. If you look at the next slide, it goes back to the end of 24. So we're looking at the last, let's call it 6 to 8 months. Okay. You can see what happened. It's been on a bit of a decline. Interest rates have been sticky in the States. People have been a little bit unsure what's going to happen. You can see there was a big spike down on the 31st of March. And that was the time when, the interest rate story came. That was, I beg your pardon, the tariff story came up, those earlier slides, and people basically said, whoa, we're not going to do anything. We don't need to order. We're just going to fill our cupboards full of inventory and see what happens from here on, but we're not going to be doing any major spending thereafter. Obviously, oil sort of said, hang on, people aren't going to be traveling, people aren't going to be doing this, interest rates are still high. But you can see what's happened. It's recovered. And during the period 31.3 to currently, what has happened? We've had major infractions and inflections in the Gulf of Yemen. The Houthis have been taking out targets in the Red Sea. The Gulf of Hormuz was nearly closed. 20 million barrels a day could be stopped. There's all sorts of things been happening. The Middle East, Israeli, Hamas thing has been escalating. There have been B-1 bombers flying over and dropping bombs on Iraq. All sorts of things have been happening. But look, it's basically come back to where we started in March. So yeah, a lot of volatility. It goes up and down. If you look at it between 60 and 75. So that's where it's been sort of sitting. And if you look at the next slide, it takes it a little bit even further back. If you look at it, it's actually gone sideways. Yes, sure, depending on when you get in, if you were buying a particular stock as a direct investment, for a 4-year period, you could have bought right at the top of that peak, and you could be, sort of down where you are now. And that is the issue of holding a direct stock. That's the beauty of a descending autocall, because per annum in this particular note, we've contracted a 10% reduction. So that price level will be coming down 10% per annum in order for us to order call and to release those coupons. So, oil is volatile, overproduction, political, maneuvering. It is there. But at the end of the day, if you stretch it out, it is actually gone sideways for the last period, which has been very, very volatile in terms of geopolitical issues that have been affecting investment decisions. So let's go back to my protectionism, because that's what it's all about. This is the protection of the American MAGA, Make America Great Again. And America went from a net importer to an exporter after, pretty much after COVID. Some of you may have been around long enough where Lloyd's, I beg your pardon, where we actually launched a note just after the crash. It was around about June, July. Chad, you'll probably know, June, July 2020. And the world had gone into lockdown. We weren't out on a move. Industries were grinding. They'd been closed. People were at home. And obviously, the guys who were producing oil said, well, where do we send our oil to? Because nobody's using it. And it piles up at these reserves, at these refineries, at these storage depots. And eventually, the storage depots ran out of space. And they said, well, we can't take any more. The ships must just stay out there or go back to where you came from. So there was a bit of a collapse of the oil price, okay? And we did a strategic note. It was going to be, the world was going to unlock again. And we thought at this price, you have to go in and buy these companies, particular companies. And we actually bought exchange traded funds. We didn't buy individual companies. And that note lasted, I think, if memory serves me correctly, 9 months. It had a coupon of, I think, 1.5% a month. And after 9 months, it was over because the oil price just took off again. Very much like that previous slide. There's always going to be this volatility. And if you've got the 4-year time span to appreciate that, and you've got a descending order call, it's great. But this is interesting from the point of view that America now is exporting oil. And I was surprised. I thought Saudi Arabia was the biggest oil producer in the world. It's got the biggest oil company, Saudi Aramco, but it is not the biggest oil producer in the world. It's America, followed by Russia, followed by Saudi. And then there's Venezuela, who hasn't quite tapped their stuff yet. But America is now, because of the Permian Basin, which is their major oil reserve, which they're now tapping through shale, it's shale extraction. They are now becoming exporters to the world. And guess who's in there? Our friend Chevron, Occidental, which is a big Buffett play, and ExxonMobil. Just to come back to Chevron, Chevron sits in Berkshire Hathaway, which is Buffett's vehicle for investments, and I think at the current time it's in his top 5. So he's always been a big oil man. I'd love to have Occidental Petrol, which is Occidental Petroleum, which is his biggest pick after Apple, which he's been reducing. But Graham and I looked at it, and it just brings there's too much safety. That's why, to Graham's point, we needed something there to build up the coupon to 17%. So with the Enterprise guys coming out, we're looking at pretty much a 2-horse race, if you want to call it that, which is the oil majors, 2 global companies, and probably the Constellation, which is probably one of the biggest, if not the biggest, nuclear company in the States. As I mentioned, the 3 Mile Island, they're actually having to negotiate to get that reopened simply to service Microsoft's power requirement. They signed a 20-year deal with Microsoft, as they have with Meta. So we're going to move now on to sort of a quick summary. Energy is your lifeblood. It's as simple as that. I can't say anything more. And the US has got this strategy to say, we are circling the wagons. We are going to protect America, and we're going to protect American energy interests. Oil and nuclear are going to be the way to go. They've but they've disregarded, they've pushed to the side renewables, unfortunately. But that is the key to their policy and strategy. And from tonight, that is real anecdotal sort of ratification that the corporate activity, as we saw with NVIDIA and Meta, they're starting to come through now saying, all right, let's make this thing happen. We do not want to lose our market positions. And quite frankly, if you want to succeed in anything, you need to own energy. In any war, I'm a great study of history. In any war, it's the first asset you go after is energy, the energy requirement of another country. And they are looking to protect their own first. So putting ourselves into American shoes, I certainly believe this is a note for the moment. It's a note for the foreseeable future. Trump has another 3.5 years to go. Midterms are next year. I don't think much is going to change. I think we're going to see these tariff things keep going on. And I think the big American companies who've got great political vested interests are going to do very well out of this. I think what Chad and Jill are going to explain is the actual mechanics of the note are going to skew it even more in favor of getting these coupons out, 17% per annum, which is really is a phenomenal, top draw type of return in today's markets and volatility. Right, over to somebody else.
Thank you, Andrew.
Okay.
Chad, do you want to run through this and then I'll run through the graphs?
Cool. Right, cool. Andrew, always fascinating to listen. I'm going to speed it up. See, it's nearly the top of the hour. So again, BBVA Bank, we're very comfortable with. We've done a lot of work with them. Coupon, well done, Graham. Well done, Andrew. 17%. It is a growth coupon. It's going to potentially auto call early, but the maximum term, the maximum duration of this would be a 4-year. We'll have a look together with Jill just now on how it is possible that the product could mature earlier. And we need to get to 100% of the value, and this is going to reduce by 5% semi-annually. And the first observation would be at 12 months. So the minimum period to run is 12 months. From there, it could potentially auto-call or close out early, as we all know. The reference basket will adjust. We know who those people are. Thanks, Andrew, for the detailed explanation. Capital protection, while we love structured notes, even if the shares drop by 50% from their start price, our capital is fully protected. We wanted to auto call so we can get the return, of course, on top of this. The availability, as Andrew said, was the 25th of August, or if we hit full subscription. And the investment in this case is in USD, and the minimum is 10,000, and any 1,000 above that if you'd like to go further. So all in all, a great note. Maybe Jill, you want to take us through the back end on how this would work?
Perfect. So just to run through the order call feature, because basically this note's got two features. One is the order call feature and one is the capital protection barrier. So the order call feature, quick refresher, it triggers an early maturity. For a structured note that is a growth note, it has to auto call in order to release its coupons. So what happens is it'll automatically mature and pay out when the underlying basket is at or above the order call trigger, and that is set at various observation dates. With the reducing auto call, this trigger level actually drops at each observation, making it easier and easier for you to achieve that auto call, which is exactly what we want. Our important information and dates, we always love this slide because this is on your fact sheet where it gives you the exact dates of the observations. It gives you the date that the funds would be released from the investment bank to your trading platform, and then it shows you the order call trigger level that you need to achieve in order for the note to order call. And then at the very end, your final observation, you've got your 50% capital protection barrier. In terms of what you need in order to access the notes, for those who haven't done this before, I know there are quite a few people that are all ready and set. They've got their trading platforms open to trade. We have got an online trading platform that you would need. We are platform agnostic. There are a list of platforms on our website that hold the notes. We are not particular in which platform you do use. It holds custody of the note on your behalf. You let us know that you would like to invest in the note, or if you have any questions, we will provide you with the ISIN number. That is the International Securities Identification Number, which you will then use to instruct your trading platform to trade into the note. From a reporting perspective, we will keep you informed. We notify you of the issue of the investment, what the strike prices were, because at each observation, the strike prices are going to be compared to the prices on the observation date, and that will determine whether you've reached a trigger or not. Each observation, we will send you an update of what's happening in the market. Andrew always puts a commentary together for that. And then on an early maturity or an auto call, we'll notify you of that as well. And then from an ongoing support basis, we provide updates. We provide refresher training for anybody that would like to just have a quick little refresher on any of the features, and then general support. That is what we are there to do and provide. As Andrew's mentioned, closing date for your instruction and your funds to be cleared on your trading platform is the 25th of August. The note strikes on the 26th, so there's no wiggle room. we have run it right to the very, very end. So with that, I'd like to open the floor to questions. I don't know if there are any questions.
Yes, there's a nice question from Andrea. Could I ask you to go back to the coupon payment and observation slide, please?
Yes.
Thank you.
Which one?
There we go. So Andrea, if you go to the question is, if at final observation, they're both above 70%. So in all those cases, Andrea, you can see the dotted line represents the income trigger and the order call level. So as soon as the stocks are above the auto call level, as you said, the 70% at final observation, if the shares are above that, in other words, they've dropped by 30%, which is, we believe, maybe unlikely, it's not advice, your full coupon payment will come out together with your full capital. So we want to be above those dotted lines at observation in order to take the coupons that are accumulated up until that point and receive our capital back. I hope that answered your question.
And all three stocks must be above the trigger.
Yeah. Graham, thank you very much. Andrew, thank you very much.
Absolute pleasure as always. Just to interject there, guys.
Sure.
So as far as the hedge is concerned, which Andrew was discussing, happy to state that that as a consequence of the way that the basket has changed, and the fact that quite honestly you have such a strong influence on these counterparties, your name is revered in corridors. They have accepted to maintain the coupon of 17% and allow a 30% increase in your hedge. So that's quite something. It's very rare that we get that situation. So well done to you guys for that. So that's really, really good news. And yeah, you made the point on the strike date. Logan, that'll be something that you'll need to keep your eyes on, because that strike date is going to be tight. So yeah, well, fantastic, guys. Very, very well done.
Excellent. And then the recording will be out in a couple of days' time as well.
All right, super. Lovely to see everybody again. And if there are any questions, perhaps you're shy, don't be shy if you email or contact us. You know how to get us. And thanks again. Dan, Anthony, nice to see you as well. Chet and everybody else, thank you. Have a good evening.
Excellent. Thanks, guys. Bye.
Thank you.
Thanks again, Andrew.
Cheers. Bye-bye, everybody.